here to talk today about revenue recognition, but more specifically as it relates to the manufacturing and distribution industry. I am Albert Traverso, a partner here for the firm's manufacturing and distribution practice. And also here, sitting by my side is
Josh Shinani, partner, manufacturing and distribution practice.
Thanks for joining us. Our firm has done a number of these presentations regarding revenue recognition, but this one is specific to the manufacturing and distribution niche. And let's jump right into it. So some objectives for today. By the end of the course, participants will be understanding the overall approach in the new revenue recognition guidance. They'll be able to determine how the accounting policies may be affected by this new guidance. And hopefully participants will also be able to identify those areas within your respective company that's going to be impacted by this pronouncement. The new pronouncement is effective for annual periods ending December 31st, 2019. So what we're really talking about are years starting January 1st of 2019, which may seem like a long ways off, but as we all know, it'll be here before you know it. If you happen to have something other than a calendar year, like a June 30th year end, you're looking at an annual period end of June 30th, 2020. So some key principles here. Why has this pronouncement been put out? And some key things to keep in mind as we go through revenue recognition. Essentially, what the FASB is looking to do is for revenue recognition to be recognized in a way that reflects more of the transfer of promised goods or service to customers. It's about the actual transfer of goods, not necessarily when cash is exchanging hands. And the overall pronouncement also contemplates looking at the amount of revenue that should be recognized in proportion to and equal to the consideration at which the entity expects it's going to be entitled to collect for those promised goods and services. So some practical applications for the M&D companies that are out there. You do have some companies that have maybe variable pricing issues, and those would be things like volume discounts, rebates, and bonuses, possibly coupons or some other type of voucher that provides some type of a reduction in what would normally be the selling price of a product. Certainly returns, as well as just other types of price concessions and discounts that perhaps are, more related to the overall normal course of a business practice within a specific company.
So we're going to do our best to touch on some of these topics as we go through the presentation. Again, items being specific to manufacturers and distributors. Things like multiple performance obligations, warranties, and royalties, as well as you're going to see there's been some changes in the timing for recognition on sales involving distributors and bill and hold arrangements. Okay, so let's jump right in. So revenue recognition with respect to ASC 606 will be done in accordance with a 5-step model. Those 5 steps include, number 1, identifying the contract with the customer. The second one is identifying performance obligations in the contract, knowing that there may very well be more than one. The third step is determining what the transaction price is. The fourth step is allocating the transaction price between the different performance obligations. And then the last step is to ultimately recognize revenue. Okay, so how do you identify contracts with customers? There are certain criteria that must be accounted for, okay, in order to account for revenue under this pronouncement. All of these pieces must exist in order to recognize revenue. The first point is that commercial substance must exist. There must be approvals obtained on both sides and a commitment to perform on those attributes. There must be rights of both parties that are easily identifiable, and identifiable we're going to talk as we move on. Payment terms, again, are identifiable as well, and different than under legacy GAAP, we're going to consider collectability as to how we recognize revenue.
All right. So identifying a contract with a customer. Some of the things to consider when going through the evaluation process as to whether or not you have a contract is going to be, first of all, in terms of your contracts, do they have cancellation provisions? And are those cancellation provisions unilateral by a customer and without cause? And are there penalties for the cancellation? You have to consider whether or not collectability is probable. You could very well have multiple contracts at or near the same time with the same customer. And so the new pronouncement here requires an evaluation of, well, what do you really have? Do you have one contract with multiple deliverable dates, or do you in fact have separate contracts? And then, of course, contract modifications, and what do you do when you actually have a modification and there's been a change to the scope? In other words, the actual promised deliverable and or the price. So customer existence, if the customer contract does not meet all of the contract existence criteria listed below, then it calls into question whether or not you actually have a contract with your customer. And if you don't have a contract, you're going to recognize a liability for any advance payments that you've received. You're going to have to reassess the criteria each reporting period as necessary to determine if the criteria has been subsequently met. And if the criteria continues to not be met, under this guidance, the revenue will only be recognized in certain prescribed circumstances.
Okay, so we do have an example in terms of trying to identify who the customer is within a contract. We'll give you 30 seconds to read the next two slides. Okay, so Alexander Enterprises, Inc., AEI, operates a website that allows customers to purchase directly from the entity and also enables customers to purchase accessory products from other suppliers who ship directly to the customer. AEI requires payment from customers before orders are processed. When the website is used to purchase goods from another supplier, the entity receives a commission equal to 5% of the sales price. Sales prices for accessory products are set by the other supplier, and the website is used to facilitate the sale. Who is the customer? I'll give you a second to think that through. Oh. So for those of you reading this example, obviously this is similar to an online retailer, an Amazon type situation. Of course, there are a number of other manufacturers and distributors who actually do online commerce. And so in this example, there are actually two different customers here. And the answer is for sales products directly to consumers that AIE.
Webinar on revenue recognition.
The consumers.
Can you all please mute your phones? Thank you.
The consumer, there's the direct consumer where Alexander Enterprises sells directly to, but the second customer actually where AEI is acting as an agent for sales of accessory products that are just coming through on the web, and AEI has no obligation to the customer except to connect the consumer with the other supplier. So in that instance, the customer is actually the other supplier that is supplying those products. So as you can imagine, when you're thinking about your contracts with customers, identifying who the customer is may or may not be as straightforward as originally thought.
Right. And for those of you who are taking copious notes, I do want to point out, Al, that all revenue-generating contracts with customers are within the scope of ASC 606, except for the following contracts: leases, insurance contracts, various contractual rights and obligations related to financial instruments, guarantees that are other than warranties, and certain non-monetary exchanges. So although we are focusing today on manufacturing and distribution, as Al mentioned before, there are no industries who were scoped out of this revenue recognition pronouncement. So, keep that in the back of your mind. Some of you may work for companies who span across multiple industries, so this is not just specific to manufacturing and distribution. So let's move to step 2. So first we identified the contract. Now we're going to identify performance obligations within that contract. So the question you're all asking yourself is, what is a performance obligation? Well, a performance obligation is a promise that exists in a contract with a customer in order to transfer distinct goods to that customer. Remember, under legacy GAAP, it was not focused on control of goods, but instead transfer of risk. So that's an important change as we move through the new revenue recognition announcement. And it's also important to note that multiple goods or services promised in a contract may need to be combined into distinct bundles.
Just a friendly reminder for those participating today, if you would please mute your phone. We do appreciate it. Thank you.
Okay. So there can exist multiple performance obligations. We're going to get into those over the next 2 slides, but certainly shipping and handling activities may or may not constitute performance obligations. There may be an obligation to deliver multiple goods or services. And in addition, multiple goods and services in a contract include product sales and can also include options to purchase additional products in the future. So some examples of industry performance obligations are manufacturing an asset, the installation component, implementation, telephone support, maintenance for the product, training. So all these things in the past that we considered to be part of the sale now have to be broken out individually and evaluated separately to see if individually each one indicates its own performance obligation. So we first talked about shipping and handling. Now the accounting depends on whether the shipping and handling activities occur before or after the customer obtains control of the promised goods. Remember, we focus on control. So if they happen before, it's included as part of the fulfillment activity as we process the good to get it ready for the customer. If it happens after, it's considered to be a promised service. Now there is the ability to elect under accounting policies that an entity can elect to treat the promised services, which again, as we said before, comes after the control is transferred, to be included as part of the fulfillment activity. So part of the original purchase price. If it does, at the time that the product, that the control transfers, from a financial accounting standpoint, an accrual has to be recognized at that time equal to the cost of shipping those goods.
So, performance obligations. Determining if a promised good or service are actually performance obligations. If the promised good or service is distinct then it would be considered a separate performance obligation. There is an exception to that rule, of course, when you have a series. When you have, multiple shipments, perhaps you have a scheduled timeline for multiple shipments of a particular product on a purchase order. So there is an exception when the promised goods or the service is part of a series, although they are distinct. But if they are essentially the same and have the same pattern of transfer, then this is really the series. It's a series of distinct goods and services. Is the performance obligation. So you would collapse it all and consider it one contract. Under performance obligations, so if the promised good or service is not distinct, then it really just kind of gets lumped into the other performance obligations that exist. And going back to our example of shipping that Josh mentioned earlier, you really have to take a look at how do you conduct your business when it comes to shipping. If it's just part of the sale and it's not something separate that a customer would be able to purchase separately, and it's customary for you in your business that shipping is just part of what we do, then you would not have a separate performance obligation, and it would just become part of the sale.
Right, and Al, even just to add on top of that, so, in the past, if we would have products that would ship FOB shipping point, okay, and at that time previously we would recognize revenue, if we still bear the risk of loss, if the products never get to the end user, then technically under the new revenue recognition standards, we have not given up control of those goods, and revenue cannot be recognized until those goods are actually received and the responsibility has been transferred to the end user.
Right. So one of the other things to consider, which may be common, which is common in the manufacturing and distribution world, is options. Options for additional goods or services that provide the customer the ability to purchase items or purchase services at a different rate or at special rates that otherwise the general population or other customers are not entitled to. And what we're talking about is the material right. And the material right allows a customer to purchase additional goods or services at a discount higher than the discount that would be offered to other customers. So in an example, perhaps maybe you have a customer who purchased 1,000 pieces, but a customer who purchases 1,000 pieces or reaches a certain threshold, they now have an option. They can buy at another, let's say, an additional 10% discount. Well, that 10% discount, they have a right to buy that additional material at a 10% lower cost. That's something that would not be offered to anyone else, only to that customer because they've reached a certain threshold. That material right is, under the new standards, a separate performance obligation and would need to be valued and considered in the overall revenue recognition model.
So warranties, we all know warranties well and good. What's the reason for them? Well, the typical warranty gives the customer assurance that a good or service will function as the parties intend. But as we all know, we've all bought cell phones and other things like that. Additional warranties may exist that provide assurance beyond this original grace period. Okay, so again, some reasons for warranties. Well, they're required by law. The contract promises that the warranty will be in place, and it's customary, it's good business practice to say, hey, if it doesn't work, if it's broken, if it's not performing in accordance to your standards, then you have the right to return that good. Okay, so there are different types, as we mentioned before. So there's warranties that are included with the sale of the good or service, right, where it's implied, depending depending on the type of product, you may have a warranty that's good for 60 days. You may have a warranty that's good for 1 year. For a piece of heavy machinery, it might be 5 years. Or there's warranties that are offered separately, right? I was at the store over the weekend. I bought a vacuum, and they said, you know, would you like to purchase the additional warranty? It covers the vacuum for another year. That's an example of number 2. So there's different types of warranties. The customer cannot purchase the warranties. Okay. So if the customer cannot purchase the warranty separately and the warranty does not provide a service, okay, then under legacy GAAP, we would account for it in accordance with how we account for guarantees. So for example, on the sale of an appliance, the warranty indicates an appliance will function as the parties intend for 60 days. Anything beyond 60 days, we're not on the hook under the original warranty. In order to accrue a loss, 2 conditions must be met. Information about the probability or the experience of a loss, and the amount can be reasonably estimated.
So in terms of revenue recognition, if you have a warranty that is not separate and distinct, there is still some consideration that would need to be given in order for the accrual for that expense. So it would not necessarily adjust your revenue number, but you would need to consider what are the costs that are going to be incurred for future warranty claims that will be coming. So under the that really hasn't changed under the new revenue recognition standard. The accounting for warranties only change when you have a separate performance obligation related to warranties. And so we have an example here. We're going to go over the warranty example. So you got a smartphone manufacturer grants customers, you know, a standalone warranty with the purchase of its product. The manufacturer provides assurance the product is going to comply and agree with agreed upon specifications and will operate as promised for 1 year. The manufacturer also includes up to 5 hours of technical support to the customer, and the customer purchased the phone and also chooses to purchase an extended warranty for an additional year. So how many performance obligations would you have in this type of scenario? Well, in this type of scenario, you would end up with 3 individual performance obligations. You have the sale of the phone, you have the technical support, which is separate and distinct, as well as the extended 1-year warranty. The standard, again, as mentioned before, is not a separate performance obligation because it's just included. There was no option for the customer to buy it, and so therefore it's not a separate performance obligation.
Okay, so in the world we live in, we all know volume discounts. So certainly an entity provides a customer with the option to purchase goods in the future at a discount from current prices, depending on the volume purchased. We look at this prospectively, not retrospectively, okay? We must evaluate whether the volume discount is considered to be a material right. And by that I mean, we must consider whether the option to purchase at a discount exists independent.
For an individual whose phone has gone on to music, I'd appreciate if you could mute that, please.
So if the material right does exist, it would be considered a separate performance obligation. Okay. All right, we're back. So again, if a material right does exist, it's considered to be a separate performance obligation, in which case the transaction price should be allocated to the performance obligation based upon the standalone selling price and then recognize later when the discounted goods are provided or the volume discount expires. So we're going to get into some examples later as to how to account for volume discounts when we get into determining and allocating the transaction price. Okay. Step 3.
Right. Determining the transaction price. So what's the transaction price? As defined by the new standard, it's the amount of consideration to which an entity expects to be entitled in exchange for transferring those promised goods or services to the customer. All right. It excludes amounts collected on behalf of third parties. One thing to note, under the new standard, when determining the transaction price, no consideration is to be given to the credit risk of the customer. That comes later and is outside the scope of this particular pronouncement for revenue recognition. So the forms of consideration, I mean, it could be fixed cash, could be variable, there could be a significant financing component. Some manufacturers that are, manufacturing durable goods, there may very well be a financing component associated with the sale. Consideration payable to the customer, right? There could be some money that's given back to the customer, as well as non-cash consideration. So what are we talking about? We're talking about rebates, coupons, volume bonuses, returns, price concessions, and other forms of discounts. Variable consideration. So under the new standard, the transaction price should generally include all consideration to which the entity expects to be entitled to collect, including any variable consideration. And the variable consideration does need to be included in the price, and it's going to be based on the best estimate of the amount of consideration to which the entity is going to be entitled. So there are some estimates that are involved here in the new revenue recognition standard. And including in those estimates, they're to be included in the transaction price only to the extent that it's probable that a significant reversal will not occur. So there is some great care that needs to be taken into account when trying to record and come up with, well, what's the price when you have variable consideration?
So just like before, we talked about volume discounts looking prospectively. Well, volume rebates, we actually look retrospectively. So we can reasonably estimate and determine that the customer is going to hit the volume necessary to earn the rebate, then we need to start accounting for that all along or go back and adjust the revenue recorded in prior periods. So let's talk about an example of a volume rebate. So Company X enters into a contract to sell bottled sports drinks to a retail customer for $20 per case on January 1st, 2009. The contract stipulates that the customer is entitled to a $10,000 cash rebate if aggregate purchases exceed 5,000 cases during the calendar year. At the contract inception, Company X determines it has significant experience with this product and with the purchasing pattern of the customer, and concludes it is probable that a reversal of revenue to the rebate will not occur, as they don't expect the customer to purchase 5,000 cases during the calendar year. This is where knowing your customer's purchasing pattern and history really comes into play, because it helps you account for these transactions all along. Again, this is really one of the reasons for the change, is to more timely reflect accurate financial information. So if we can reasonably expect that the customer will never hit those 5,000 cases, then we know that our estimated transaction price will continue to be $20 per case. So if we were to change some of those facts around on the next page, so if we consider the same from January 1st, 2009 through June 30th, 2009, the customer purchased 3,000 cases, okay, then we can reasonably expect that they're going to hit that 5,000 case threshold. So, based upon our understanding of the customer's purchasing, what should the company recognize in revenue? Okay, so in the past, historically, only up until the point that the customer hit the purchasing capacity, the company itself would issue a rebate. But now, if we can reasonably assume that they will hit that amount throughout the year, then we're going to go back and we're going to adjust the revenue, assuming, the rebate discount. So the question is what should the company recognize as revenue? So if they were to purchase the full allotment of 5,000 cases, we would record $100,000 of revenue. However, and if they did hit that, then we would issue it. Then a discount would be earned equivalent to 10% or $10,000 on the 5,000 cases. So from a revenue standpoint, as of June 30th, they've hit 60% of the threshold. They would recognize 6,000 of that $10,000. We would recognize 6,000 of that $10,000 discount, and therefore we would only record $54,000 of revenue. Now the financial records should still reflect gross sales of 60,000, but they would be offset by a related discount or a contra revenue of $6,000.
I think this example highlights very well, what the change in the revenue recognition, the new standard has done for revenue recognition. It really requires that a hard look at your customers, their buying patterns, and estimating whether or not those customers are going to reach those performance obligations or those promises of what's the discount, what's the rebate. And if they are, then reporting entities need to be factoring that in earlier periods, not just once a company has reached that threshold.
So recognizing revenue with respect to one performance obligation is pretty simple. The challenge becomes allocating transaction price when you have multiple performance obligations. So again, what are the steps in allocating transaction price? Well, first, we're going to estimate what the standalone selling price of each performance obligation is. The next step is we're going to determine whether any discounts or variable consideration, as we talked about before, should be allocated to one or more of those performance obligations. And then the third piece is we're going to allocate the transaction price. So this is determined at contract inception. The best evidence of allocating transaction price is the directly observable price charged by the entity when they sell the goods or services separately in similar circumstances to similar customers. If a directly observable price does not exist, then we're going to estimate what the standalone selling price is with the best available information that we have. So there are three approaches. There are three approaches that are mentioned within the standard. The first is the adjusted market approach. The second is what the expected cost approach is for the company, and the third is the residual approach. And again, this is not limited to any of these approaches specifically. You have to determine what the best approach is given the scenario. Okay, so let's do an example. Okay, so an entity enters into a contract with a customer to sell three products, A, B, and C. The price for those three products is $100. The entity will satisfy the performance obligations for each of the products at different points in time. So we're not delivering A, B, and C all at the same time. The entity regularly sells product A separately. So therefore, we know what the standalone selling price is. However, the standalone selling prices of products B and C are not directly observable. So because the standalone selling price for products B and C are not directly observable, then we're going to have to estimate what the selling prices of those two products should be. So to estimate the standalone selling prices, we're going to use the adjusted market assessment approach, okay, for B, and the expected cost plus a margin approach for product C. And we'll get into the calculation on the next slide. But in making those estimates, we're going to maximize the use of the observable inputs, and there's further language in the paragraph described below as to how we do that. Okay, so currently we know the standalone selling price for each three. So for product A of $50, these are directly observable, right? As we said before, we sell these on a standalone basis. For the selling price of product B, we're going to use the adjusted market assessment approach. And for product C, we're going to use the expected cost plus a margin approach. So the standalone selling price is calculated here. For product A is $50, for product B is $25, and for product C is $75. So if we were to sell these three components by themselves, we would have a cost to the customer of $150. However, as we noted before, the cost to the customer is only $100. So what do? So the customer receives a discount for purchasing the whole bundle. And essentially what it is we're going to do is we're going to have to allocate the transaction price. So as we identified before, the cost for product A of $50 represents a third of the standalone selling price. Product B would on an allocated basis represent $17, and on an allocated basis, the price for product C would be $50. So as you see, we're taking this essentially from $150 back down to $100. So this is how the spread would be recognized in the accounting records.
All right, and so after you've done all that, now you finally get to recognize that revenue. So let's go through that revenue recognition, the fifth and final step. Recognize the transaction price, right, allocated to the performance obligation when or as the performance obligation is satisfied. In our earlier example, if you recall, A, B, and C were not all being transferred at the same time. So the timing of the revenue recognition when evaluating when to recognize the revenue is a process that needs to be gone through. And a performance obligation is considered satisfied under the new standards as control of the goods or services transfers to the customer. So it's all about control. And control is considered to have been transferred when the customer has the ability to direct the use of the goods or services and receive substantially all the related benefits to those goods and services. And one of the things that a reporting entity must do is evaluate, how is that control, how is the control actually being transferred? Is it over time or is it a point in time? And certainly the answer to that question, depending on how it's answered is going to drive at what point and for how much of the revenue gets recognized. You may have situations, though, where a customer simultaneously receives and consumes benefits as the entity performs. And in this situation, this is where essentially the revenue recognition is considered to be satisfied over time. Some things to look out for, though, when you do have this, when you're considering this, you have to look at whether or not is there another entity that can step in and fulfill the remaining performance obligation. So if you're selling something, if you're selling a product or performing a service, and someone else can step in, you may have something that's going to block you from recognizing that revenue. As well as if the customer controls an asset, the customer controls the asset as it's being created. So if you're manufacturing something, say a long life asset, maybe it's a durable good, a car, a plane, or something that takes longer than a year. You have to evaluate based on the contract and what the terms are of the contract. As that asset is being built, who still retains control over that asset? Does the customer control that automobile that's only 25% complete, or that plane that's only 25% complete, or that other durable good? Does the customer control it, or does the reporting entity still control it? These are the types of questions that need to be thought about before actually recognizing the revenue. Revenue recognition. So the obligation is considered to be satisfied at a point in time when the customer obtains that control. All right, indicators that control has transferred. The entity has present right for payment for that distinct goods or service because it has been delivered. And if one or more of the following have transferred or passed to the customer: legal title, physical possession, and significant risk or reward of ownership. Another indicator is that the customer has accepted the distinct good or service, that it's actually been delivered and is now on site at the customer. So sales to distributors. So this is, under revenue recognition, if your company works with distributors and you have that level, that intermediary between the direct customer and you, the manufacturer, you need to look at your contracts, because under legacy GAAP, the results for revenue recognition, essentially, revenue would not get recognized until there was a sale to the end user, because that's what the legacy GAAP said. However, under the new revenue recognition standard, there's no requirement that the sale actually happen to the legacy, to the end user, to the end customer. If the distributor is involved and the distributor has control over the goods and has a right to the use of those goods, there may very well be an argument to be made that the revenue should be recognized with the sale to the distributor, because the distributor now has the control and the rights of over those goods. And an indicator that you would have if a distributor has the rights for control over those goods is that the goods may not have actually shipped. The goods are still in your warehouse, but if those goods cannot be used to satisfy any other customer orders, that's an indication that the distributor actually has the control over the goods, and you may very well have revenue to recognize, even though there has been no final sale to an end user, an end customer.
So when you talk about transfer of control, Al, typically in a consignment arrangement, we're not giving up control until that good or service has been completely paid for. So under a consignment deal, under the new revenue recognition standards, we do not record revenue upon the delivery of the product until that obligation has been satisfied and the money has come back where it belongs. So in addition, we have some customers who operate under a bill and hold arrangement. So as we all know, with respect to a bill and hold, we may bill the customer ahead of time, but hold on to that good, in which case transfer of goods has not taken place. So company sells a copy machine, right? We may have billed the customer, prior to that copy machine being installed and the customer ultimately taking responsibility for it and certainly attesting to the fact that machine has been installed and working. So in this case, the revenue cannot be recognized until the customer has accepted responsibility and control of that good. So where this comes, sometimes into play is that we build a good, again, we're manufacturers, then that good is stored in our warehouse. So we may have billed the customer because we have performed on our end the construction of the good, but we're warehousing it at this point in time. We may not be able to recognize revenue because, again, the customer has not taken control of that good.
So bill and hold transaction, let's go through an example for bill and hold. Entity enters into a contract on January 1st for the manufacture and sale of a machine, along with some spare parts, with a 2-year lead time. Contract consideration is $100,000. Upon completion, the entity demonstrates that the machine and the spare parts meet the contract specifications. The promise to transfer the machine and spare parts are distinct and result in two separate performance obligations, satisfied at a point in time. On December 31st, 2019, the customer pays for the machine and the spare parts, but only takes physical possession of the machine. And upon taking physical possession of the machine, the customer accepts the machine and is able to direct its use and receive substantially all the remaining benefits. So that's where we would recognize the revenue for the machine. The customer accepts the spare parts, but requests that the entity store the spare parts. The customer has legal title, and the spare parts are identified as belonging to the customer, even though they still remain with the manufacturer, the reporting entity. The entity stores the spare parts in a separate section of its warehouse. The parts are ready for immediate shipment at the customer's request. And the entity doesn't have the ability to use those spare parts or direct them to another customer. Some additional assumptions. The entity concludes it has an additional performance obligation for the warehousing of the spare parts. So depending on what happens with delivery of goods, you may very well have an additional performance obligation, depending on what your customer requests. And if there are relatives, in our example, if we have relative standalone selling prices for the machine and the spare parts and those warehousing services, right, what is the appropriate accounting treatment for the sale of the machine, the parts, and custodial services? So when the machine is sold and transferred, and it's going to recognize revenue essentially of $86,364. It's that ratio of the total of the combined of all the performance obligations, $110,000, but the contract price in total is only $100. As you can see, there's going to be an allocation that's made of what gets recognized for the machine, for the spare parts. Now, for the custodial services and what's being allocated there for the custodial services, that will be recognized. Over the period of time for which they're holding those goods and actually performing those services.
Okay, so a couple other matters here to wind this down. Certainly the accounting will change, but so will the required disclosures in the footnotes to the financial statements. It will increase significantly, and the purpose of this webinar is not to get into all of the disclosures, but some examples of categories that might be appropriate to include, but are not limited to all the following are, the types of goods or services, the geographical region, the market and type of customer, certain types of contracts that the company enters into, what the length of the contracts are, how the timing of transfer of goods or services is recognized, and certain sales channels that the company sells through. So all of these factors are key towards how a company will recognize revenue in the future. So there are certain disclosure examples that are out there that are in the pronouncement, and we certainly encourage you all to take a read through and take a look at them.
So overall, why is the FASB doing this? Well, right, from their perspective, they're looking for greater clarity, greater transparency to help the readers of the financial statements. And so as disclosures get enhanced, it's incumbent upon those reporting entities to be able to produce the information necessary for those disclosures.
So what's potentially on the horizon here? Well, the FASB itself has a subcommittee, which is called the Private Company Council, which advocates on behalf of private companies back to FASB, and they're currently petitioning the FASB for certain relief and provisions with respect to this revenue recognition pronouncement, But as of today, you know, the implementation certainly remains January 1st, 2019. There has been no modifications, and we move forward. I know Al and I have kind of gone through this in, you know, 55, 60 minutes, but the pronouncement itself is very complicated. It's very challenging. We certainly encourage everybody to read the pronouncement, but again, that's why we're here. You know, please feel free to consult us, and we certainly wish you luck in the implementation. Are there any questions?
We're just checking the online status for questions, and it doesn't appear like anybody has any questions. So Josh, we must have done a great job of explaining this and answering everybody's question regarding revenue recognition. And we thank you for your time today. And certainly, should anyone have a question in the future, by all means, reach out to either one of us. Thank you, everyone, and have a great day.